Enron. It's an amazing example in the series with how business actually works. So there's actually a documentary. It's called the Enron, the smartest guys in the room. You can watch it on YouTube. It's really highly recommended. It's like an eye opener. The CEO, Jeff Skilling, said that the only difference between me and the people judging me is they weren't smart enough to do what we did. And what did they do? They created a company that just went all the way to the sky. And when you're at the sky, it's a long way down. And when you're looking at the numbers from Enron, then if you look at the net income, then the net income in 1999 was 827 million. That's pretty good, right? 2,896 million. And then the first quarter of 2001, 405 million. So that means the first quarter of 2001, they almost made 50% of the net income of the previous year. And for the first 6 months, there's a little bit discrepancy with the numbers, but they made around 788 million. So they almost, within the first 6 months of 2001, made the same net income as they did the previous year. And then 5 months later, boom! And a lot of people lost their money. So in the documentary, they were talking about like people lost around $3 billion. They were crying. But then other people won and they got $1 billion. You can say that all the poor people with their pensions and so on and so forth. So they lost their money, then they got some money back. But then at the end, I think the lawyers took all the money away from them. So the people who were laughing were the people who understand the game of business, which the lawyers did here, right? So the lawyers made a lot of money, like fighting these cases, right? So this was the first video in the series, The Game of Business. And in that one, I talked about Warren Buffett, and Warren Buffett said, accounting is the language of business. So Warren talked about, I mentioned that in that video too, that like, don't invest in something you don't understand. And one thing you need to understand is that profit is a theory and cash is a fact. But with Enron, that kind of wasn't the case. So I'll show that in this video while we talk a little bit about Enron and we learn a little bit more about these pieces of paper and a little bit of an introduction to this language, which is accounting. So I already mentioned that we had these net incomes in these years, and when like people just skim it, then it looks good. Like they're looking at the net income, they're looking at earnings per share, and you see like that looks pretty good, right? The thing is that here it says that the ending cash of 1999 was 288 million. In 2000, it was 1.3 billion. And the first quarter of 2001, it was 1 billion. So like that looks pretty good, right? But if you took your thinking hat on and like just learned the basic things within accounting, then you would be able to read some of these papers that is released by the company, and you would understand that this cash that they put here actually isn't real, right? So we'll cover that later in this video. So every company in the S&P 500 and all companies that, if you run your own company and you're not a drug dealer, then you have 3 pieces of paper, or at least 2, right? So you would have a balance sheet and you would have an income statement. All the S&P 500 companies, they also have something called a statement of cash flows. But the thing is that if you have 2 of these, if you have the income statement and balance sheet, then you can recreate the cash flow. If you have the cash flow and the balance sheet, you can sort of recreate the income statement. So everybody in 2001, when Enron crashed, had access to the 3 pieces of paper from 2000 to 2001. And all the smart people on Wall Street, the smartest people in the world, right? They said the following. So in March 2001, Lehman Brothers, they're not here anymore, right? But they said, this Enron thing, it's a strong buy at 61. At 55, Merrill Lynch said, near-term buy. Goldman Sachs, again, some of the smartest people in this world, they said, recommended list. Then 3 months later, in June, the price was a little bit down, somewhere between 45 and 51. Bear Stearns, who's not here anymore either, said, this one is attractive. JP Morgan said, buy this thing. A.G. Edwards accumulated. Then a few months later, in August 15th and September the 6th, Bear Stearns, they thought it was attractive at 51. It's still attractive at 40. JP Morgan at 30. So they liked it at 47. Now it's 30. You should still buy it. Then in October, Goldman Sachs, they recommended that you buy it at 55. And at 33, they still recommend that you buy it. JP Morgan, they thought you should buy it at 47. They thought you should buy it at 30. At 33, they still think you should buy it. A.G. Edwards, you should still accumulate this thing. Merrill Lynch, they changed it. So at 55, it was a near-term buy. At 33, it's a long-term buy. So what happened next is that the price went down, kind of on sale, these stocks at Enron. So on October 22nd, CIBC, it's a Chinese bank, said, you should buy this thing. At 16, First Avenue said, buy this thing. JP Morgan, long-term buy. Lehman Brothers, they said it was a strong buy at 61. All right. Now it's 16. So it lost around 70% of its value, right? But Lehman says, still, it's a strong buy. So it was a strong buy at 61, and at 16, it's still a strong buy. The stock is attractively priced. At 16, Bank of America says market perform. So what does this market perform mean? So market performs that it can go up, it can go down, it can go sideways, it can stay where it is. We have absolutely no idea what is happening to this thing. So that is what market perform means. At 16, Smith and Barney said, buy this thing. Then in November 1st, CIBC, buy this thing. Merrill Lynch, they're now neutral. Prudential, hold. Edward Jones, maintain position. Goldman Sachs, market perform. CIBC, hold. So neutral, hold, maintain position means that, okay, so we already lost a lot of money on this stock. So we probably shouldn't buy it, right? So if you don't have it, you should not buy it. If you have it, you should probably not sell it because you already lost so much money on it, right? So hold this thing. On November 28th, UBS Warburg said at $0.61 said hold. Credit Suisse first Boston at 0.36 said hold this thing, right? No one said you should buy it, right? You should hold this thing. And what happened was that on the 29th of November, there was an article from Business and Classified. It said Enron on the brink of bankruptcy. And on December 2nd, 2001, the stock price went to zero. And all the people who listened to all the smart people and held on to their stock, they have the stock now forever. And the light that was Enron turned off. And the thing with Enron was that profit It's a theory. And cash is a fact. But it wasn't really with Enron. But everybody, every single investor, all of these smart people at Wall Street, they know that every single year you should get 3 pieces of paper. You should get a balance sheet, you should get an income statement, and you should get a statement of cash flow. When the year turned from 2000 to 2001, everybody got these 3 pieces of paper. And everybody could read them. The thing is that in these big companies, then you should get these 3 pieces of paper every 3 months. So that means at the end of March, all the investors, everybody who has the shares in this company, they should get these 3 pieces of paper. And what happened was that Enron didn't give the shareholders or the smart people at Wall Street 3 pieces of paper. They only gave them one, the income statement. And that is a huge red flag. After the 6 months, April, May, June, they're supposed to give you 3 pieces of paper. They only gave one, the income statement. People were still holding on to the stock while it was like going down towards the bottom. And then after the 9 months, there was no paper at all, not even an income statement. And some of the smart people said, like, you should still buy this thing, right? And then at the end, there wasn't any pieces of paper because then they went bankrupt. So if we look at it and look at the numbers, this is the Enron Corp consolidated income statement. So this is the one everybody had. And what we can see in this one is that with the net income, then in 1999 and in 2000. So we can see that it was 827 in 99, 896 in 2000. Then the thing that happened was that on the Tuesday, April the 17th, then they made a news release. And when I look at the news release, it said that the net income has increased to 406 million, which is like pretty cool, right? And when it was July, then there was another one of these, and it said that the net income had increased to 404 million. So that is pretty cool too, right? The thing here is that we're missing 2 pieces of paper. And for the third quarter, there weren't any pieces of paper. But then luckily, I found on the internet, that the United States Securities and Exchange Commission of Washington, they made a 9-month ended report on September 30th. So what they wrote here is that the operating income was a loss of 917 million for this quarter. And the net income was minus 644 million. So it's important to just have the basic understanding of things and understand that you need 3 pieces of paper. You can't just do with one. The thing here is that when we have a statement of cash flow, which is like the most interesting piece of paper in Enron, then a statement of cash flow has 3 parts. So it has a part on the top, that is the operating cash. Then it has investing cash, and then it has financing cash. There's one type of cash that is much, much more important in a company than any other kinds of cash. Can you guess which one? Where do we want money to come from when we are investing in a company or we own our own company? We want the money to come from the operations. We do not want the money to come from investing. So investing cash is we will spend money if we buy something. So Enron bought and built a power plant in India. They bought some power barges. So when they buy this, then they take cash and then they spend it on investing cash. If they sell something, like sell the barges, then they get some of the money back, right? So like when a company buys property, plant, equipment, then it hurts investing cash. When they sell property, plant, equipment, then they make money, right? So that is like one of the things Warren Buffett made a lot of money on is looking at the investing cash opportunities in the company. So he was talking about like cigar butts. There's a pretty good documentary about Warren Buffett you can watch on HBO Max. And then there's the third kind of cash, which is financing cash. So financing cash is when we borrow money or we repay money. So interest is not part of the financing cash because that's like paying rent on the money we borrowed. So that actually hurts our operations. So if we look at these three kinds of cash and what Enron said about it, then we can see that I have the net income up here. So what they said in their cash flow statement was that in 1999, the operating cash was 1.2 billion. In 2000, their operating cash was 4.8 billion. And the thing there is that when I see that number and the operating cash goes from 1 billion to almost 5 billion, then I get a little bit curious, right? So like what is happening? Why is this number so big? Right? What is going on there? And the first quarter, so we these are guesstimates from later on, right? But the loss on operations here were 464 million. And for the first 6 months, Enron burned and destroyed 1.3 billion cash on the operations. So maybe they should just have stayed at home, right? That could have saved a lot of people a lot of money. So on investments, they spent 3.5 billion on investments in 1999. In 2000, 4.2 billion. In the first quarter, 1.1 billion. And then for the first 6 months, 1.1 billion. Right? So you can say that the good thing with Enron was that they only spent money like the first quarter of 2001, and then they didn't do a lot more investments that year. Right? With financing, then in 1999, they borrowed 2.4 billion. In 2000, they borrowed 500 million. The first quarter of 2001, they borrowed 1.3 billion. And in the first 6 months, they borrowed 1.9 billion. So the interesting thing here is that, like in the documentary, they said at the end of the year, like investors and pension funds lost like 3 billion, but actually like they borrowed 2 billion, right? So like you can say that one thing we can learn from Enron is that they were amazing, like very, very, very good at borrowing money, right? Right? They were not very good at making money, right? But they were very good at borrowing money, right? So that's like a cool thing. There's a lot of more stuff you could be talking about this, but then what happened is that when you lose like 1.3 billion on your operations and you are still buying stuff, right? Then at some point you don't have any more cash and then the company had to close. And then a lot of people were out crying, right? And a lot of people were like, oh, this is an opportunity to make some money, right? So they were like making books came out, documentaries came out, like how to keep your money safe. Enron exposed how millions of innocent Americans lost their life savings. And the auditors from Arthur Andersen, we knew nothing. And then in this article, there's actually like a funny thing. So Lewitt described the cultural economic erosion during the 1990s in which companies used questionable accounting practices to meet profit expectations. Once some started, others had to do the same thing to remain competitive, Lewitt said. So the thing is, they use something called mark-to-market accounting. So that means when they decided to build a power plant in India, then they made a guesstimate of how much money, how much profit they would make the next 10 years. And then what they did is that they took that profit and then they put it in their sheets and said like, oh, this is net profit. So we already made this money. Then the problem for them was that they finished building this power plant, and then the Indian people didn't want to buy the electricity from them because it was too expensive, and then they didn't make the money. But the money was already put in the books. Same thing, I have membership and courses, and then I think, I'll have like a million members in 2 years, right? And I'll make this, and then I'll just put it on the books now like I made the money, but I haven't made the money. But the thing is, if you are then a competitor to me and you're making courses too, and then you don't do that, right? So you sell 10 courses, let's say you sell 100 courses the first year, and then that is what you put on your books. But then when we have people who wants to invest in us, right? So they look at Palle and like, oh, Palle, he sold like 1 million. He has a lot of net income from selling these courses, right? I haven't sold any, right? But I have like, on the books, it looks very good. Where the other guy like, he only sold like 100, right? Then people are going to invest in my company, right? So that is the same thing. That is like what they said, like the people who didn't do this, they were losing, right? Because you can't compete. And then after this, right, they were found guilty, right? This will mean prison for the ex-Enron chiefs, right? So they got not that long, but watch the documentary about it, like ask ChatGPT. So statement of cash flow. It has 3 parts: operating cash, investing cash, financing cash. When we're looking at the crash of Enron, and we look at the news report that came out in April 17th, 2001, then when I look at this piece of paper, and if I was an investor, I would not be that worried, right? I would look at this and like, okay, so 20% increase in income to 406 million. No biggie there. That sounds pretty good, right? It was like 50% of the previous year's net income in 3 months. So that's pretty good. Then some people say, Palle, but they lost some money on their broadband, right? This internet thing, right? They lost 35 million, right? But when I look at that and I'm saying, okay, so they just had like over 400 million, right? So their trajectory for the year is going to like 1.6 or like 2 billion, right? Then I don't really mind that they lost like 35 million on a new leg of their business. My problem with this is that they only gave me an income statement. So no statement of cash flow and no balance sheet, right? So I can't see what is going on, right? And that is a red flag. So that is a red flag that would mean, maybe I shouldn't invest in this company, right? Because they are hiding something. And it became like more transparent, you can say, in July. Because with the press release in July, again, we were only getting this income statement. And even though this says like a 40% increase in net income to 404 million, if I just look at that, like, okay, it's still on the trajectory to make like 1.6 to 2 billion, right? And then it lost 102 million on the broadband, but who cares, right? Like everything is like growing, it's going amazing. But the main thing here, the main red flag is that they only gave us one piece of paper. And if I only have one piece of paper, I can't see anything. It makes no sense. I need the other 2 pieces of paper. It's like going to the doctor, and the doctor is looking at me, and he has no idea if there's like something wrong with me or if I'm okay, right? So in order for him to see like what is going on the inside, he would need to go and take some blood samples. Because maybe there's like cancer, maybe there's something else wrong with you, right? You can't see it, right? And what you can't see will kill you. And it's the same thing with the business, right? What we can't see will kill us. And that is why it's very, very important to have these 3 pieces of paper. So if we imagine that we go back in time, and it's the year changing from 2000 to 2001. So this is a statement of cash flow from Enron. So Enron has something here that is called changes in components of working capital. So that's because on the balance sheet, you have something called AR, which is good for cash. AR is bad for cash. You have something called AP. AP is good for cash. And then you have inventory. Inventory is bad for cash. It's because if we buy something and put it in our warehouse, then we have to spend money. Accounts receivable, AR, is like we send out a bill or an invoice, but people haven't paid us yet. So that is bad for cash. AP is account payable, so that means like that's bills or invoices we need to pay, but we haven't paid yet. So that is good for cash. The thing when I'm looking at this changes in components of working capital, then the difference between 1999 and 2000 is 2.8 billion. Right? And this is also, if you look at the 2000, that is where you have the 4.779 billion. And they have like something weird called additions and unrealized gains of 1.3 billion, something like that's hurting the cash flow. But like it would be like a very strong. But just let's look at this one. The thing with the changes in working capital is that on the bottom side of the statement of cash flow, it actually is explained a little bit where these numbers come from. So what they said here is that receivables, so account receivables. So that means the year before in 1999, then they had 662 million. So that means customers, where they've sent them an invoice, owed them 662 millions that they haven't paid them yet. So that is bad for cash. Then in 2000, that is 8.2 billion. So customers who's been getting an invoice owe them 8.2 billion. So that is bad for cash. Inventory. So inventory, buying something, putting it in the warehouse is bad for cash. The thing here is that their inventory is plus. So somehow they managed to get their inventory to be positive. Which is like maybe, right? Maybe they had a negative warehouse where they sold some stuff in the warehouse that they don't have. You see, that raises a question, like how on earth is their inventory negative? So that means like they sold some stuff that they don't have, right? Because inventory is usually bad for cash. But here at Enron, inventory is good for cash. So that means like they sold something that they don't have. Huh? That's a red flag. It's a red flag. And then we have the payables. So payables is good for cash, right? Because they haven't paid their bills yet. But then they invented something called other. And we don't know what this other is, except that the year before it was 41, but now it's 1,400. But we can agree that like it's weird that their inventory is minus, right? So they sold stuff in the inventory that they didn't have. And then there's something other. But these two numbers are like 1.3 billion and 1.5 billion. So if we again go back and look at the numbers from 2000, then we can see that the ending cash of 1.3 billion. So that actually equals to the inventory that they sold, right? So that means that they have already sold the inventory. So they need to buy the inventory back, if that makes sense. Yeah. So that means that thing alone makes the ending cash to go to zero because they sold inventory they don't have. And then you have the other thing, which was 1.4 billion, right? So if we put that one there, because we have no idea if that's what that is, right? Then the ending cash is actually minus 1.4 billion 2000, right? So all the smart people, that was like saying buy, right? Everybody had access to this information that something was wrong with their inventory, right? Everybody had access to these things, right? There are more things you can look at in the cash flow statement and other pieces of paper, but there are like these things, right? And you see, those are things we need to pay attention to. The thing here is that profit is a theory, but here cash was a theory too, because they turned their inventory into cash. They sold something that they didn't have, or else they just made a mistake in the accounting, right? So here, profit was a theory, cash is a theory. Usually in normal companies, profit is a theory, cash is a fact, right? And the only way you can go bankrupt is if you run out of cash, right? So that is what happened with Enron, right? Enron ran out of cash, right? So maybe the cash was on the piece of paper, right? But it didn't exist, right? And when the money doesn't exist, and if no more people wants to borrow your money, then you go bankrupt. So it's important when you invest in a company to know that at least you need 3 pieces of paper. If people knew that back then, and they would say I can have a standard like Warren Buffett says, right? So I will only invest in companies that give me 3 pieces of paper, right? Like all the other companies, right? Then in April 2001, you would have sold the Enron stock, right? Because they didn't provide what your standards are, right? So I will only do that, right? You can also have like a standard that says, I will only invest in companies that don't make funny stuff with their statement of cash flow, right? And it doesn't take that much. Like when you dig a little bit into it, it's not that complicated. The thing is that is complicated is like as a business owner or like as an investor, there's no value in a number. But we need to understand and like see, can we figure out where the number comes from? And if we have a number in our own company, in our own business, the value is knowing what to do about this number. So that was a little bit about Enron. In the next video, I'll talk about the importance of optics a little. What do you think about the Enron thing? Did you learn something? Did you find it interesting? If you're new to the YouTube channel, subscribe so you can see all this cool stuff, right? If you like the video, give it a like. If you don't like it, give it a dislike. If you want to, join our Treasure Hunter Entrepreneurship membership on thesecretway.com, right? Else, that was all for me in this video. Thanks for watching. Have a wonderful day.